This process is surprisingly slow with a lot of delays throughout. On average, banks take 5 days to issue guarantees. What would you say are some key causes of this delay?
I think in the trade finance industry, AI offers several benefits beyond efficiency. This can enhance various aspects like your operations management, risk management, customer experience, and strategic decision making.
Hello and welcome to Trade Finance Talks. My name's Mahika Ravishankar, Assistant Editor at Trade Finance Global.
I'm Suchi Guharoy. I'm the Head of Solution Consulting at Surecomp.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast, brought to you by TFG.
Considering the pace of digitisation in industries across the board, the uptake of digital solutions in trade seems to be moving incrementally. This is paradoxical since supply chain resilience is essential for the functioning of the global economy, and more so because lack thereof is extremely costly. Banks and corporates are central to the rollout of trade finance solutions. They are well aware of the problems that can arise from lagging behind in the race to digitisation. In this regard, trade finance software for financial solutions and developments within this arena are monitored closely. Today, I'm joined by Suchi Guharoy, Head of Global Solution Consulting at Surecomp, to discuss how AI can be implemented to resolve such bottlenecks. Suchi, welcome to Trade Finance Talks.
Thank you, Mahika. Thanks for having me here today.
So just to kick things off with some quick introductions, who are you, where are you from, and what do you do?
I started my career working for one of the largest commercial banks in India and then moved on to doing more senior product-focused roles in organizations like FIS, Temenos, and Oracle. In Surecomp, I lead a global team of functional and technical subject matter experts who are very dedicated to delivering unique, customer-centric trade finance solutions to all our customers across the financial industry and the corporate world. I deeply understand the banking and the financial market landscape with over 2 decades in wholesale, retail, and commercial banking. Personally, I am quite deeply committed to advancing digital trade finance solutions, enabling our clients to navigate the complexities of global trade with ease and efficiency.
Thank you so much for that, and sounds like from your background you'll be well placed to discuss issues with supply chain management. So what do you think are some key issues with supply chain management facing the banking and corporate industries today?
I think the supply chain management in the banking industry, this obviously involves managing relationships and processes with multiple vendors, service providers, technology partners. Some of the key issues facing the banking industry that looms large are essentially quite a few. I'll start off with the complexity of onboarding, the complexity of regulatory compliance. The banking industry obviously is very highly regulated, and supply chain processes must comply with various international and local regulations. Now, managing compliance across a diverse supply chain can be extremely tedious, time-consuming, and obviously involves a lot of cost. The second piece is obviously around the digital transformation and the cyber security that looms around with it. Banks are increasingly relying on digital solutions, making them vulnerable to cyber threats and cyber attacks. Ensuring the security of these digital platforms in the supply chains with third-party vendors, that is critical. The third element which springs to mind is vendor risk management or third-party risk management. Banks often outsource various functions, right? And this makes them reliant on third-party vendors. Obviously, this poses and increases the risk of disruption, compliance issues, and data breaches. Finally, I would say operational resilience, lingering still on from the COVID-19 pandemic, ensuring continuous operations amidst lots of these disruptions, geopolitically, naturally, disaster-wise, any other crisis, name it, that's a significant concern. So I think the financial industry, banks, corporates, they would need to bake in resilience in the operations of their supply chain management process.
Thank you so much, and that leads neatly onto the next question. What would you say are some other key learnings from the COVID-19 pandemic besides the requirement of resiliency?
The COVID-19 pandemic provided several key learning to this entire process of supply chain management in the banking industry as well as with all our corporates. I distinctly recall in 2019, and when the pandemic hit, we waited for 4 months to get the bike for my 6-year-old, and then we'd moved houses So I waited for 11 months for my sofa to get delivered. That's classic, right? I was one of the millions who were obviously impacted, affected by the disruption in the supply chain. If I were to summarize some of the learnings, one definitely is the importance, again, I'll come back to resilience first because it highlights the importance of resilience and flexibility. It actually highlighted the need to have very resilient supply chain processes that can adapt to sudden changes like the COVID pandemic. Sudden lockdowns, working remotely, that was a game changer for all of us in the industry. Banks needed to very quickly learn and adapt to very flexible contracts, adaptable service level agreements, etc. with their suppliers. The second bit was digital acceleration, and I cannot harp more about it because the shift to remote work, digital transactions, this all accelerated the digital transformation that the industry went through. Banks overnight realized the importance of investing in a digital infrastructure and to obviously have robust cybersecurity measures to support the changes. Eventually, I would say this all resulted in banks, financial industry, corporates, all of us learning that an efficient supply chain visibility is very key to the whole process. Now, the pandemic underscored the need for greater visibility, transparency of data across the entire ecosystem. We all learned the value of real-time data monitoring, data analytics, to be able to predict and forecast the changes and to be able to manage and mitigate the risk.
It sounds like while a lot of great developments came about in terms of enhancing the need for visibility, transparency, adaptability, a lot of important lessons came from the COVID pandemic. Now we're starting to see that these developments have, with all of these new developments, basically we're in a new place, a completely new arena. And in this space, would you say that issues like trade-based money laundering and fraud have been exacerbated in recent years?
Yes, definitely. I think trade-based money laundering have been significantly on the rise, right, due to several factors over the last few years. Interestingly, I think a couple of months back, I was reading up the United Nations Office on Drugs and Crime estimates anywhere between 800 million to trillion globally over the year. That's about 5 to 6% of the global GDP, and that's scary.
Oh, wow.
Yeah, so I think international trade by its very nature is very complex. It's a complicated thing. It's international. It's disaggregated. Now, when you add another layer of complexity with differing national regulations, information silos among the multiple actors that are involved in these transactions, like freight forwarders, your custom brokers, financial institutions, the rapid expansion of free trade zones, it's no surprise that TBML is a challenging issue to address. There are various factors, obviously, which are, adding fuel to the fire, shall I say. So the increased digital transactions, as more banking operations, banking processes are moving online, there is obviously a greater opportunity for fraudsters to exploit the digital channels. This is obviously significant given a rise to the TBML activities, and criminals are finding new ways to disguise illicit funds through trade. Misinvoicing, under or over invoicing, it's becoming very, very prevalent. I think there was a report about 63% of the trade-based money laundering is reported via misinvoicing, and that's again very hazardous.
Sorry, just quickly for the listeners, would you mind just maybe in one or two sentences explaining what these methods of TBML and fraud are? Like just a quick definition of misinvoicing, underinvoicing or overinvoicing?
Yeah, so for example, when your supplier would invoice you for an amount which is higher than the value of the goods that he has shipped, or when he would under-invoice you than the actual amount of the goods that is shipped. So that signifies misinvoicing, that in a sense says that your invoice is not accurate to exactly relate to the goods that have been shipped to the buyer. That kind of gives in an avenue for illicit funds to be channelized, because obviously your invoice was not true to the amount of the goods that you have received, and you're able to sell and retrieve the money back. There are different other areas. I think the regulatory gaps also play a major role. There are inconsistent regulations across the countries and the regions, and these create vulnerabilities that can be exploited for TBML. The fraudsters are also finding much more sophisticated ways of conducting fraud. Obviously, Obviously, they are using advanced technologies like AI and machine learning so they can conduct TBML and evade the detection. So I think all in all, banks are investing in advanced technologies so they can actually enhance their fraud detection capabilities and they can improve the transparency and security and be resilient to this ongoing fraudulent activities.
Thank you so much. And I guess it's just the crux of development in any arena is that regulation just never seems to be able to keep pace. To move on to banks and how banks issue guarantees. This process is surprisingly slow with a lot of delays throughout. On average, banks take 5 days to issue guarantees. What would you say are some key causes of this delay?
There are quite a few significant reasons which contribute to the delay in issuance of bank guarantee. I think if I were to summarize the top ones, firstly, this involves very complex and complicated documentation requirement. Banks require vast number of documentation before they can issue guarantees, including the proof of financial stability, credit assessment, doing very rigorous and enhanced due diligence and compliance checks, gathering these data, verifying, processing, and reviewing the data. These are all very time-consuming, especially if the client's paperwork is not complete or if they are incorrect, for example. The second thing is most of the large banks or the banks who are focused on trade finance business have a very small bespoke team who are focused on doing these kind of manual checks and controls. And this population is aging. There is a vast number of people or there's a vast number of retiring population who are actually contributing, doing this specific tasks in banks, using manual processes, using legacy systems, which are obviously then inefficient. They are prone to errors. They're outdated systems, etc. I would say the lack of democratization of this ability to do this activity is key, because then what happens is I am restricted to this bunch of few people who can conduct the activity. And if, for example, one of them is not available, they are sick or they are away, then the entire process gets stuck, because then your internal approvals get stuck. There is lack of coordination between your departments, etc. I think if I were to also then talk about, there are certain periods of high demands and there are periods of backlogs when there is a delay because of the lack of coordination and there's a bottleneck because of large volumes of guarantees, peak periods when the banks are processing, and that might actually pile up on the delays that the banks might have.
And these repercussions, would you say that they're costly to the bank?
Oh, absolutely, indeed. And the impact is severe. Let me start with the business impact, because that's where it hits the most, obviously. And that results to financial impacts and customer satisfaction, etc. But if I were to start at the business disruption, I would say the massive delays in issuing guarantees by banks directly disrupts the business, right? Especially organizations, companies that rely heavily on these guarantees to secure contracts or to fulfill their trade agreements. That leads to missed opportunities, it leads to contract penalties, etc. What does that mean? That directly means that there is a financial impact on these organizations. There are a huge amount of financial losses because your shipments have been delayed, you have missed your deadlines, you have missed the ability to secure a favorable term with your preferred set of clients or your preferred set of suppliers. This can impact the cash flow and the overall financial health. If I keep going on there, it obviously means there is a huge amount of repercussion, loss of trust, the loss of reputation for banks and financial industry, because clients then would look at competition that are offering faster ways, more efficient, more reliable ways to provide them the bank guarantees than this particular bank or the organization. Obviously, all these would lead to a high operational cost. There is a huge risk of regulatory and legal implications, because if you have prolonged delays due to the banks delaying in the issuance of bank guarantees, and that actually poses a non-compliance for your customer to actually obey certain contractual obligations, then that means a hefty penalty. There is a huge amount of risk, I would say, at stake with legal disputes, regulatory scrutiny, etc., that the banks might face. And obviously, all of this leads to the customer dissatisfaction, the repercussions of which could be life-changing.
Thank you so much. Clearly a big risk to the functioning of business. So how would you say some of these delays can be ironed out?
There are various initiatives and various strategies that corporates and banks at large are adopting to mitigate these risks. The first thing is automation, bringing in more of digitalization to the solutions. When I was previously speaking about manual entries, heavy reliance on legacy systems, manual intervention, this is exactly where we should be targeting to improve and enhance the efficiency and the resilience. So implementing digital platforms, automating the process, right from application submission to review to approval, being able to automate the entire process of issuing a digital bank guarantee, the ability to ingest unstructured data from an email or from a Word document that's been sent to you into structured data, converting it automatically, being able to read the terms and conditions, the expiry date, the legal connotations, the transference, etc., quite automatically, that reduces a whole lot of manual delay that would have otherwise risen from the operational process. The other element which is becoming significant is enhanced communication between all the parties. So a 360-degree communication, collaboration, online, real-time on a digital mode, to be able to establish clear, distinct, online, real-time communication instead of waiting for paper-based communication and delays in communication between the bank, applicants, any third party, shipping companies, logistics companies, compliance organizations. All of this really helps in streamlining and resolving their queries quite quickly.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it.
Thank you so much. So, automation for efficiency and automation for communication. What would you say are some industry-specific benefits of AI? Everyone tends to talk about efficiency in automating processes, but what else can AI offer?
I think in the trade finance industry, AI offers several benefits beyond efficiency. This can enhance various aspects like your operations management, risk management, customer experience, and strategic decision-making. Some of the key advantages that I particularly see is obviously an enhanced risk management and fraud detection, a topic that we were talking about just a few minutes back. I think AI can really help analyze vast amounts of data to identify patterns and anomalies that may indicate fraud, or it may indicate high-risk transactions such as the trade-based money laundering. Machine learning algorithms can actually help detect unusual transaction behaviors and then flagging potential fraud more accurately than the traditional methods. This should finally actually go on to the improved credit assessment and decision-making abilities, because if you utilize AI in the process of credit assessment, it can actually analyze a whole lot of non-traditional data sources over and above your transactional data, like your social media data or your market trends, global news alongside. And this holistic view allows for more accurate risk assessments and credit decisions. These are the top two things. I think the next piece which comes to my mind is a very personalized customer experience. Having AI-powered tools like chatbots or virtual assistants, this can actually provide a lot of personalized support and guidance to customers in real time. They can answer your queries, they can handhold you through the application process and through the workflow process and provide very tailored recommendations on your specific needs and transaction history that you have. The other element, I would say, is predictive analytics, and that's again very crucial. Data all the way. So transparency in data, having predictive analytics, using AI to predict your future demand and supply, that is very critical. It can actually help you set the trends, analyze historical data, market conditions, global economic conditions, and obviously then help business to make very informed decisions about their financial needs. I can also think about enhanced collaboration and the ecosystem integration. So with AI facilitating better integration between all the partners of the trade finance ecosystem, both upstream and downstream, to enhance information, including banks, insurers, shipping companies, etc., to automate your data sharing, to automate communication, to automate collaboration, and to actually ultimately lead to a very connected and transparent trade finance environment.
Just to clarify there, how would AI help to improve communication?
I think what it essentially does is it renders better integration across the trade finance ecosystem. You would help automate the data sharing across all these partner ecosystem. So you can typically use AI to actually automate the services that you render to each other and have open integration services between all the parties to actually share data uniformly, collaboratively across all the stakeholders.
Thank you. Yeah, I guess a one-word summary would just be data then.
That's true.
So I saw the announcement this morning that Surecomp solution Revo has been adopted by EP Resources, the global commodities trading house. Can you tell me a bit more about the Revo solution for banks and corporates?
Yes, of course. Revo is one of our flagship solutions. It is a strategic platform that Surecomp has, and we are investing about 20 to 30% of our annual revenue in enhancing and bringing in a lot of innovation around this solution. Revo, in a sense, has three primary mantras of engage, connect, and enrich. At the core of Revo is the ability to foster real-time collaboration, and that's something crucial between all the parties and the stakeholders in the trade finance process. Again, be it the exporters, banks, insurers, or shipping companies. This collaboration is quite embedded within the platform and the workflow of all the trade finance instruments, and this enables the ability to share documents either in public or in private modes on an online real-time digital basis. One thing I think it's worth mentioning is obviously the ability of the businesses to automate the whole transaction. Again, a few minutes back, we were talking about how cumbersome it is for banks sometimes, which causes delays in issuing bank guarantees. I would really like to highlight how in Revo we have used artificial intelligence to automate this entire process of issuing guarantees. So we are able to actually ingest unstructured data, for example, from an email, take in the relevant contexts, terms and conditions, legalities, etc., and automate into structured data to significantly reduce the number of days that they were spending earlier to process bank guarantees. So immediate results in operational efficiency, reducing costs for organizations. And I think I'd finally like to conclude by saying Revo really enables enrichment of data. Obviously, we've got a cutting-edge technology, and this has very detailed reporting capabilities powered by AI and Power BI reporting tools, which allow the users to generate advanced analytics, both pre-built and custom, to track transaction performance, provide transparency, monitor compliance, and analyze business transactions overall.
Thank you very much. Yeah, sounds like some really fascinating developments. For me, if I was like a bank or a corporate institution, I think one thing I would be really concerned about when implementing any new system is ESG compliance. So that's environmental, social, and governance. Can you say Revo contributes to ESG compliance?
Yes, indeed, of course. I think Revo contributes quite significantly to ESG compliance in multiple ways. The primary thing is Revo automates the entire process of trade finance, and it digitizes the entire process of trade finance. And by doing this, Revo reduces or literally eliminates the need for paper documentation. This obviously contributes significantly to environmental sustainability by lowering the carbon footprint associated with traditional paper-based methods. I think one thing which Surecomp is also keenly looking forward to is the ICC setting out standardized framework on ESG governance and the practices. What we would like to do is then pivot all our ESG initiatives once the frameworks are published and standardized by ICC, and then adopt that in our solution. As part of the fintech collaboration that I was talking about, Revo can be connected to multiple ESG solution providers who can actually give a steer on the sustainability matrix that can be embedded into the bank's financing methods and processes.
Finally, to wrap things up, I'm sure the industry has absolutely transformed since you joined the banking sector about 20 years ago. What do you think is next? Where do you see the industry in the next 5 years?
That's a very pertinent question, and my head reels to see the kind of advancements and developments that have been made over the last 2 decades. And it's very fascinating to see where we are heading over the next few years. I think there are quite a few significant trends and practices that I'm seeing, and I think would only evolve over the next few years. I'll start off with increased digitization and automation because that's very key to the industry. It's also something which is very close to my heart. The industry will continue to shift towards an end-to-end digital trade finance solution. This is pivoted towards reducing reliance on manual processes, paper documentation. The world needs to come together to eliminate the delays and operational complexities that looms large amidst multiple stakeholders. At this point in time, we are all witnessing the rise of digital trade, the rise of e-documentation. Quite a few countries have made it as an act, right, at this point in time. So the adoption of electronic documents, e-bill of lading, this is going to gain more and more traction globally, supported by legal and regulatory changes. This is something which is key. The next thing would be the ultimate focus on ESG and sustainable trade finance. I think there will be a super strong emphasis on ESG compliance and sustainability in trade finance. Financial institutions are going to increasingly offer trade finance products which will align with ESG principles like obviously green financing options or sustainability-linked loans. And obviously there will be incentives given for keeping and adhering and bettering your ESG matrix over time. The next thing is enhanced collaboration. I think we are really all actively in this industry looking forward to a collaborative trade finance world where information does not reside in silos, where information is not disintegrated as it is today. The future will actually see enhanced collaboration. Any platform that can offer this to the banks, to the corporates, to the insurers, to the fintechs, to the regulators, to keep coming on this single unified platform to facilitate seamless integration and data sharing will become really, really prevalent. This will obviously create an interconnected and efficient trade finance environment, more so with open banking, the API integrations, etc. This will allow for a lot of dynamism and flexibility within the trade finance ecosystem.
It's encouraging to hear you speak so optimistically about the future. Thank you so much for that. And it sounds like these key issues that you highlighted at the beginning about supply chain management, so complexity of onboarding, over-reliance on the digital transformation, vendor and third-party risk, and operational resilience, looks like a lot of the developments ongoing at the moment are set to iron those things out.
That's right. I think overall the trade finance industry in the next 5 years, this will be really prone towards digitization, transparency. It will render itself to more efficient, sustainable trade. And all of this would be underpinned by technological advancements and a growing focus on ESG and customer centricity. I think financial institutions would embrace these changes. Obviously, this will render everyone in the industry, all the parties, to thrive in the ever-evolving ecosystem of trade finance.
Thank you very much, and hopefully you'll never have to wait 11 months for a sofa again.
Thank you so much. We look forward to that day. Thanks, Mahika, for having me today.
Thank you.